Hi, I'm Tom Lydon, editor of ETF Trends, here in Chicago at the Morningstar ETF Invest Conference. And I'm here with Martin Kremenstein, who is the CEO of Deutsche Bank Commodity Services. Martin, thanks for being here. I appreciate it.
Thank you, Tom. It's great to be here.
So, commodities, alternative investing, it's really one of the stories of the day, especially as advisors are diversifying more away from the 60-40 asset allocation model. Now, you have a unique relationship with PowerShares in the fact that you help advise some of these very creative ETFs in the commodity space. Spend a minute and explain that.
Sure. So, yeah, the relationship we have with PowerShares has been a very, very productive and fruitful relationship for both companies. It dates back to the very early days of the ETF industry, to be honest, back to 2005, when we were building at Deutsche Bank the first futures-based commodity exchange traded fund. We had the expertise, we had the structure, we had the market knowledge. What we didn't have was distribution and the branding. PowerShares were one of the young up-and-coming ETF companies, and they had the distribution, they had the branding, and they were growing. And they also had a real kind of edge in terms of looking for alternative indices, better ways of weighting, and so with our optimum yield methodology, we really fit very well into that platform. And so the relationship as it works now is that we are the commodity pool operator and commodity trading advisor, which is the commodity version of basically being the investment advisor, and they are the marketing and branding, and we brand them both PowerShares DB. And it's a relationship that's as strong today as it was at the very beginning.
Well, I know you folks both get together and you do a great job of trying to educate advisors about investing in commodities. And again, it's something that you don't learn overnight. And the products aren't always as simple, but especially pertaining to today and everything that's going on. Okay, we've got QE3, we've got potential inflation. Maybe you could give us, a couple ideas as an advisor. If you're managing portfolios, what are some ways that you can hedge from a commodity standpoint to better position client portfolios?
So I think one of the key, one of the most attractive features that commodities have for an investor and for advisors is this very high correlation with inflation. In fact, if you look at most other asset classes, they have fairly poor correlations with inflation. Even tips are a terrible inflation hedge. They're just better than being long, straight fixed income. Commodities, however, have consistently outperformed in inflationary periods. And so getting commodity exposure in your portfolio is a very good way for advisors to protect against that. And there are a couple of ways you can do it. One perennial favorite is to get a gold exposure. Okay. Gold seems to be the kind of the go-to product whether you want inflation or deflation. It just seems to be like a safety play. But I think also broad commodities exposure, whether it's a broad basket like DBC or maybe one of the other products that are out there, should help to give you that inflation correlation, that protection from inflation.
DBC, one of the ETFs, has a cross-section of commodities, correct?
Correct, yeah. It was the first one we brought out. It's the largest futures-based commodity ETF in the world. Very big, very liquid. It's the four main sectors. It's energy, it's agriculture, it's base metals, it's precious metals. And so by putting those together, you're getting broad commodity exposure. For a lot of investors, commodities are going to be a small part of their portfolio. So they don't have the time or the expertise to devote that much amount of their time to really trading in and out. So they want to look for a broad commodity exposure for their portfolio.
And these are futures-based, correct?
Correct.
So for many advisors who've never dipped their toe into the futures world for advisors, for their clients, any concerns there?
I think with futures you have to remember that your returns are coming from three places. You've got the spot yield, which is, oil goes up, the future goes up. Everybody understands that. Then you've got the collateral yield, because you don't pay out cash for the futures, so you can collateralize them with treasury bills. And the final thing you have is the roll yield, and that's the bit I think that most people were unaware of until around 2009 when roll yield became a really big issue, and suddenly everybody knew the word contango. When we were going out on the road in 2006 when we launched DBC, we were talking about our flexible roll strategy to mitigate the effects of contango and maximize the benefits of backwardation. And most people were kind of hearing it and it's going over their head. They didn't really care, they didn't really know. People only really care when something's going against them. And then from late 2008 onwards, there was this very steep contango in a lot of markets, and certainly in the energy markets. And just to give you an example, in 2009, if you were long physical oil and you weren't paying for storage, which is a huge caveat to make, but that's what most people look at. They just look at the physical, they don't look at storage costs.
Right.
You were up somewhere in the high 60s, low 70s. If you were front month rolling oil, in a front month rolling oil product, you were up 17%. If you had a flexible roll like DBO or oil fund, you're up 45%. So ROY, our optimum yield strategy, didn't get rid of contango, but it mitigated it to the tune of about 28% for that year.
Right.
And that's something that you really need to be aware of when you're looking at commodity futures products. Commodity futures have a dynamic that's based around the expiration of the futures and the rolling that you do,
Yep.
and you need to be aware of that and how that works.
We could spend a whole segment on optimum yield, but I know at PowerShares, there's also, through PowerShares University, a lot of great educational material that you folks provide. So if you're interested, make sure that you go in and do some homework first. So Martin, thanks for your time today, and look forward to catching up with you soon. This is Tom Lydon, editor of ETF Trends.